Hi, I'm Dave Brickell, Director of Sales at Paradigm. Welcome to The Big Picture.
Vol is mean reverting. So the obvious trade is always the expensive one to
This
carry.
whole peak inflation, peak rates narrative, peak Fed, which we've been
If you
talking
don't know
about.
who you are, it's an expensive place to find out. Crypto Dvol, a potentially fatal place to find out.
The crypto option markets are definitely showing some signs of life.
Hi guys, welcome back to our recurring segment of The Big Picture with our partner analyst Greg from Amberdata. So Greg's been on the channel now, what, like four times I feel?
I think so. Yeah, 3 or 4. Yeah.
Yeah, and it's been sick. It's been some of like the best analysis that we've done, on this show, and it's really become a favorite for our viewers. So definitely want to keep doing it. We love it. And as a reminder, so Greg founded Genesis Volatility, designed specifically for the sort of analysis that he'll take you through today, and then subsequently merged with Amberdata and continuing to build out the platform there. It's really awesome stuff. Stay tuned, and before we begin, if you haven't already, smash that like, smash the subscribe button as we continue to deliver you some of the best content in crypto derivatives. So that being said, Greg, let's dive into it, man.
Yeah, absolutely. So I just want to start off with sort of our recent quarterly report we just launched in the middle of this month, in mid-July. So one of the things that we've been analyzing is essentially how Q2 performed and some of the deviations that we saw in Q2 versus the rest of the year and versus 2022. So really kind of the big theme, just to recap here, is after the SVB banking crisis, if you see this chart here, we're comparing the performance of Ether and Bitcoin year to date. Bitcoin is in orange. So you can see in mid-March, after the SVB banking crisis, that's really when Bitcoin had this outperformance, and it's been able to essentially hold on to this outperformance ever since then. And if you look here, spot vol dynamics, again, last year, Bitcoin and Ether had very identical relationships in terms of spot vol dynamics, very negatively correlated. And here, I mean, they're both hovering around 0, but you can see there's a slight positive spot vol dynamic for Bitcoin and a slight negative spot vol dynamic for Ether. So that's something that was kind of interesting, especially considering the correlation of these assets, historically speaking. You have two really correlated assets with divergent spot vol dynamics, even though it's by a small margin. So that's kind of something that's interesting and a good potential opportunity. If I scroll down a little bit more here, one of the things we wanted to highlight was the beta of ETH versus Bitcoin. So if we look at beta of ETH in Bitcoin terms, when we're above 1.0, essentially there's more beta to ETH. When we're below 1.0, there's more beta to Bitcoin. And so if we look at this chart going back to January 2021, we can really see that most of the time Ether has a higher beta, moves more. It's been as high as 1.6, but really starting in March of this year, we can sort of see that we're hovering below the 1.0 mark. And this is really what's leading to the sort of convergence of volatility between Bitcoin and ETH. And so that's a theme we've talked about a lot. So I don't want to hammer it, but it's just kind of something to throw in there to show you what's kind of going on. And if you look at a Dvol index, you can see the Bitcoin Dvol in orange, the ETH Dvol in blue. You can really see two things here. One is a structural downward trend, and then the other thing is sort of the convergence between the two. So those are kind of interesting data points on a relative vol basis. I'm going to skip through a lot of this report. You guys can download it and get it for free. I'll send a link to Joe after this.
Yeah, we'll link it in the description of the video.
So really what's interesting right now, especially because we're at these extreme low vol environments, and I'll touch on where we're currently at right now. But one of the main things I want to highlight here is the variance risk premium. So basically what we did here is we looked at the Bitcoin Dvol, and then we looked at 30-day realized. We shifted them to align them, since implied is a best estimate of future realized. So we want to really see how close that estimate was. Well, the main thing that we see here, besides sort of the structural downtrend, is that typically Bitcoin options have just been overpriced. So the variance risk premium, you can see it peaks out as high as 50 points. So that's 50 vol points on a 30-day days till expiration. That's a lot of essentially overpriced Vega. So there's something to be done there. And the other thing that really stands out is, for the exception of May 2021, when you're wrong, when options are underpriced, it's a shallow amount and it's very short-lived. So that kind of intuits essentially our base assumption for crypto options trading. And I think there's a logical explanation. I mean, this market is still nascent. Market makers only have so much capacity to essentially sell options. Like the inventory gets tapped out pretty quickly. The traditional flows that you would see where people, buy equities and sell covered calls and stuff like that, that hasn't really translated into crypto in full swing yet. We're seeing a little bit of that in ETH, but it hasn't translated in full swing. And then lastly, crypto is kind of this FOMO market. When crypto is rallying, everyone feels like they're missing out and everyone wants to get long. And so we have these periods where people will pay up for vol, and oftentimes, judging by this data, it looks like they're overpaying for that vol. And so just to compare in essentially the SPX space, if we look at the variance risk premium for VIX versus XPX, you can see it's pretty shallow. It's either up 5 points or down 5 points, but it's a very tight clustered range compared to what we just showed in the Bitcoin variance risk premium. And you could see that here when we did this strategy backtest of just selling the straddle with basic delta hedging rules, how well that outperformed. So that's something that's really interesting as well. Happy to just kind of pause it there, and then I'm happy to kind of jump into what I'm seeing right now in this space.
Yeah, I mean it's pretty. This sort of structural decline that we've been seeing in crypto vol has been very 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 apparent. But it's kind of interesting. We're now kind of starting to see a shift, I guess, in sentiment from some of the big takers on Paradigm. Like I even see it today. December 36,000 calls. Bought 1,500 times. SEP 32K calls bought around 700 times. And even just like speaking, a quote that I heard today: if I die owning Bitcoin 1 month vol at 35, then so be it. So like, do you think we're going to get to the point where of course we've kind of had this structural decline in realized and implieds are going to fall that, but do you think we kind of get to this point where, the vol is going to kind of be floored, obviously above zero, but you already think it's going to keep going lower?
So here's what's interesting. Let me share my screen here. I think there's a really good argument to be made that we will see vol come back at some point for sure. One of the things, and I was talking to Gordon over at Genesis about this, he mentioned a really interesting mental framework where it's like, you get this rumor, such as like the Bitcoin ETF, and you get all these applications, you trade that vol event, then you have the application period, which, a lot of time goes by, just dead silence, and then you actually get the news of, I'm assuming it's going to get approved, but who knows, Then you trade the actual event as well. So I think right now, especially considering in mid-March, Bitcoin is really moving on sort of macro news. Now it feels like the shift is more trading on industry news. So we had a big trading period around the XRP judgment. That was a big deal. SEC going after Binance and Coinbase. That was a tradable event. The BlackRock Bitcoin ETF application. That was a tradable event. And so we had all these industry-specific news events. And now I think we're just in that digestion period. And so there's kind of a couple things here. Let me just start on the realized space. On the realized space, realized vol is still insanely low. So this is 11 years of data of Bitcoin realized volatility. And so we can see the minimum, or let's just look at the minimum is this pink line over at the bottom. The green line is where we currently are for all these measurement periods. And then the blue lines are the lower 25th percentile, the upper 75th, and then the median is that yellow. And I took out the maximum because the maximum range can go pretty nuts. So it squished this chart. But basically what we can see here is that realized vol is basically at decade lows. So there's a good argument to be made that realized vol will come back because it's going to go back to the median at some point. Even if the median shifts down a couple points, it's still going to mean revert at some point. Now, until we mean revert, and this is something I've talked about here before, and David has pointed out me saying this, when vol is low, it becomes really expensive to hold. And so what we're seeing here is if I'm looking at 7-day realized versus 7-day implied, well, we can see that the difference in the variance risk premium, or the carry, you can look at that in the blue chart here at the bottom, the histogram part. I mean, it's almost 10 points of carry. So assuming there's no vol pickup and realize just stays here, implied is still priced over 10 points over realized. So there's a big sort of a premium that you're paying to be long vol here. And then another thing to look at is this term structure steepness. So not only are you paying a big premium over realized, but then you're going to roll down that term structure as well. And so what we're seeing here, the term structure steepness, this is the past, this is going back to 2019, I believe. So this is going to show us sort of the net discount or premium, the net backwardation or contango. And so we can see a reading of 1.0, which is the upper orange line, is a flat term structure. And then the lower orange line is sort of peak steepness in the term structure. And we're kind of just hanging out there, which makes sense because vol is cheap right now, or realized is low right now. So implied, as we kind of approach expiration, it's going to drag down to where realized is right now. And then longer dated options are going to implicitly price in some of that mean reversion. So unless your timing is right, just being long vol here is going to have a lot of negative carry to it. Right. So the way that I would structure it in my mind is that I would sort of align my long vol bet to sort of coincide nicely with a potential ETF spot application sort of decision time, because I think that will be a catalyst to bring vol back. I think until then, you're essentially just kind of relying on the macro, and we might get some macro event. I mean, it looks like long dated bonds are moving, so maybe something will happen there. But that being said, if we're looking at equity vol, we're kind of in these new post-pandemic lows. We've had the VIX as low as the 12 handle, and so typically vol, asset class vol is somewhat correlated. So like if things are going crazy in one part of the world, they're typically going crazy in other parts of the world. And so we're kind of seeing vol come down everywhere. So to me, crypto is not out of line here. And so I think long vol play has to coincide with a potential catalyst, which I think.
Yeah, and I think we've kind of been seeing this, on Paradigm in terms of kind of where the big open interest lies on Paradigm on the upside. It's really December, right? I was looking at it, Paradigm, so Paradigm specific open interest in December is by far, the biggest maturity. And it's really these December 40,000 calls, it's this December 35,000 calls, and then the 36,000 today. I mean, so the biggest Paradigm open interest position is the DEES 40Ks at like 9,000. And cool. the second biggest BTC open interest position on Paradigm is like less than half that size, right? So it kind of speaks to like people having this sort of upside view. And of course, as you mentioned, term structure is steep, and roll down can start to get pretty nasty there. But it kind of speaks to this, I guess, lack of certainty for when these ETF narratives or like this halving narrative is going to kind of start to really come into focus and intensify.
Yeah, that's awesome. Yeah, in my mind, end of the year would be sort of the more interesting place to be long vol. Yeah.
Right. And perhaps that kind of speaks maybe a little bit to the steepness of the curve, where it's people kind of selling the front end of the curve that obviously isn't realizing. You can kind of capture that variance risk premium, but then using that to kind of fund the longer dated positions out there.
Yeah, and that's a nice way to sort of, selling vol is an open-ended risk, so that's a nice way to sort of cap that risk and essentially balance out sort of that strategy. Yeah, I like that a lot. And one of the things that I like about short vol in these types of environments is like you can intuitively understand why people would be long vol in this environment. And so low vol isn't a reason for something to happen. And so what happens is, people want to buy it because it's cheap, so you could sell it to them because it's cheap on an absolute level basis, but maybe expensive on a relative basis. And then we have a reason to own vol potentially going into the end of the year. And then you can combine that with sort of long dated long stuff.
Yeah, it's pretty funny watching the flow dynamics on Paradigm, where it's in these sort of markets where vol is low, volumes are down, but then as kind of somebody kind of comes in and show some interest to kind of get long some of this stuff, all it takes is kind of one, and then you just kind of see this big sort of dogfight, to kind of, really just try to pick up, really scoop these upside calls on the lows. But, to your point, that doesn't necessarily mean, something is going to happen. And in terms of like catalysts, for a higher vol regime, like, of course, we've been talking about, the ETF deadlines. Of course, you have the SEC hearing verdicts around, grayscale, what have you. But I think an interesting stat is, so August, the month of August in pre-halving years has historically returned 18% down in the month of August. I think it doesn't necessarily mean that we need to return that this month, but I kind of find that a bit interesting, especially when you kind of look at the timing of what's going on, in traditional assets. I mean, we just had a debt downgrade. Remember in 2011, the nasty price action that we had following the 2011 debt downgrade, where I think we returned, we had an 18% correction. So, like, in terms of like catalysts, I mean, obviously it's very difficult, and it doesn't. I mean, vol can kind of go up on the downside too if we, totally. especially at these levels of vol, right? We've kind of seen that positive spot vol correlation, but if we break lower at these absolute levels, I would imagine vol is going to go up, right?
100%.
But in terms of like what you see that like a potential catalyst there, obviously we have the macro, we have the crypto idiosyncratic. How about like more like on the structural side? Like how are you looking at like gamma positioning and these sort of things right now?
Yeah, so we actually we follow gamma positioning pretty closely, and so going into the June expiration, we saw sort of the biggest negative gamma positioning that dealers had sort of on record. And then once that kind of got cleared off with the expiration, we've kind of normalized back to traditional levels. So we're kind of hovering around net zero gamma exposure. Dealers are pretty well balanced here. They're not loaded up any direction, so it gives them the capability to sort of react. They're not sitting on a bunch of inventory that they have to manage and deal with, at least by our estimation and our calculations. So I think that the way that dealers are kind of in a healthy spot here, so they can essentially react to the market in an appropriate fashion and are not squeezed on either end. So to me, this would lead to more of an efficient market. I don't think there's nothing to be squeezed in terms of positioning as of right now. That's how
about if we move higher? Because I mean, obviously, I kind of mentioned all the interest that we're kind of seeing in the 31K to 33K buckets. If we move a little bit higher, is it going to start to look a little bit shorter, you think? Or
Yep. So if you look at the dispersion of like in terms of strikes, so on a net basis, there's sort of net flat gamma. But if you look at like where is that gamma located, so above 30K, they're a little bit short, and then below 30K, they're a little bit long. So we'd have to see if like the positioning would get worse. As of right now, it's still pretty light positioning. But I would imagine if we got above 30K, we'd probably see similar dynamics that we saw going into the June expiration, where people were essentially buying a lot of call options. The street was buying call options, and dealers were essentially stuck with a lot of short inventory. I'm of the opinion, though, that 30K is kind of a clear level for people in terms of trading on a delta basis. And so my thinking is like, if we're going to go to the upside, I think 30K is probably something that people are looking at and trading around. The downside catalyst, that to me is the open-ended question on a vol basis. Even though dealers are long downside gamma, I could see something happening in the macro world that people are just kind of blindsided by, causes a downside move. I think that would be the potential for a vol pickup. I think, and that's something you pointed out, I think that makes a lot of sense. Upside vol, I think it's kind of more clear. If we get above 30K, everyone kind of understands that, okay, 40K is sort of the next level or whatever it is. And so no one's going to step in front of that train or get blindsided by it.
Right. Yeah. I mean, look, at Paradigm, whether we get, volatility because of a downside move or volatility because of an upside move, I think we'd take it either way, honestly. I mean, as you can imagine, as we talked about it on the big picture last week with GSR, our volumes are extremely tightly correlated with the level of Dvol. As you'd expect. I mean, kind of the same deal in other asset classes as well. But okay, awesome. So we are at the right around the 20-minute mark. We always kind of like to leave these sort of segments a little bit shorter, very digestible, because we kind of throw a lot right at you in these 20 minutes. So Greg, thanks a lot, man. This was absolutely awesome. I think I would love to keep doing this. I think our viewers would love to keep doing this on a periodic basis where you kind of go through these charts when things look interesting.
Absolutely. We'll love to. Thanks, Joe.